For about an hour on July 14th, Lucid Motors was worth $1.8 billion. By the end of that same day, once its own executives had denied everything, it was worth nearly double that. Nothing about the company had changed in those hours. No factory closed. No debt came due. The only thing that happened was a blog post from an outlet with almost no track record, claiming Lucid's board might be weighing bankruptcy. That claim turned out to be false. Lucid says so. The company that supposedly advised on it says so too. So here's the actual question worth asking. Not is Lucid going bankrupt? Nobody serious is claiming that right now. The question is, what does a company have to look like structurally for a single unverified rumor to erase half its value in 60 minutes? You've probably seen some version of this story already. Lucid launched in 2021 through one of the biggest SPAC deals of that era, a $24 billion valuation, positioned as the serious Tesla rival. Founder and CEO Peter Rawlinson had literally engineered the Model S. The Lucid Air broke range records. For about 6 months, this was the golden child of the EV boom. Then came the long grind down. Production targets cut and cut again. The stock fell from a peak of $577 a share to, as of this July, under $5. By any conventional measure, Lucid has been struggling for 3 straight years. That part of the story isn't new, and it isn't in dispute. What's new is July 14th. An EV blog reported that restructuring firm AlixPartners had been asked to give Lucid's board a final report on its options, up to and including Chapter 11 or taking the company private. Within an hour, the stock fell 57%, hit a low of $2.37, and trading was halted multiple times. By the end of the day, Lucid's comms chief had called the whole thing completely false on the record, and the stock had clawed back most of its loss. Here's the first piece of the actual mechanism, and it's not really about the rumor at all. In the first quarter of 2026, Lucid built 5,500 vehicles. It delivered 3,093. By the middle of the year, the gap hadn't closed. 10,274 produced against 7,046 delivered. That's not a rounding error. That's a company manufacturing significantly more cars than it's finding buyers for quarter after quarter, and it has a real cost. Unsold inventory sitting on lots is capital that isn't coming back as revenue. Lucid's response in June was to eliminate an entire second production shift at its Arizona plant, essentially admitting the factory had been built for a level of demand that never showed up. Second piece, leadership. To be fair to Lucid here, EV startups losing executives isn't unusual. Tesla's own annual executive turnover has been measured around 27%. Nikola is on its 4th CEO in 4 years. This is a genuinely churn-heavy sector. But look at Lucid's specific timeline. CFO Sherry House resigns in December 2023. CEO and CTO Peter Rawlinson resigns abruptly in February 2025. The man whose engineering credibility was half the company's pitch, Chief Engineer Eric Bach, departs that November. By June 2026, new CEO Silvio Napoli, an outsider from an elevator and escalator company, not automotive, has taken over and replaced almost the entire C-suite in under 6 weeks. The churn itself isn't the mechanism. What matters is what the churn does to everything else. A company that resets its leadership every 12 to 18 months has no one around long enough to actually fix the demand problem, which means the burn continues. Which brings us to the piece that actually pays for all of it. Since 2018, Saudi Arabia's public investment fund has put more than $9 billion into Lucid. It now owns more than 58% of the company. In April, it added another $550 million. In June, another $750 million. This is the piece that makes the other two survivable. A normal company burning cash this fast, with this much leadership instability, would be running out of runway. Lucid isn't, because it doesn't need the market to believe in it. It needs one shareholder to keep believing in it, for reasons that may have very little to do with Lucid's own unit economics and much more to do with Saudi Arabia's broader industrial ambitions under Vision 2030. Put the actual figures next to each other and the picture sharpens. Q1 2026, net loss $1.13 billion. Free cash flow negative $1.44 billion. Liquidity at quarter's end $3.2 billion or $4.7 billion once you count the pro forma raises. Against that backdrop, a $1.8 billion market cap, the low point on July 14th, was, for a moment, pricing Lucid below the cash it says it's sitting on. That's not a company being valued on its business. That's a company being valued purely on whether the story people are telling about it is a turnaround story or a death spiral. So here's what actually explains the hour Lucid lost half its value. It's not that one blog post was unusually persuasive. It's that Lucid had already built a structure where market cap tracks sentiment more than fundamentals. Capacity nobody's buying, leadership that never stays long enough to fix it, and survival that depends on one investor's patience rather than the company's own numbers. And here's the more interesting split. The funding structure itself isn't irrational. Saudi Arabia gets a Western EV brand and a functioning manufacturing base on its own soil, regardless of whether Lucid ever turns a profit as a standalone company. That's a legitimate sovereign bet. What that patience doesn't explain is the churn or the capacity mismatch. Those are execution failures sitting on top of a sound enough capital strategy. Silvio Napoli gutting almost the entire C-suite in 6 weeks is, in effect, a bet that the operations, not the ownership, were the real point of failure. The transferable pattern isn't watch out for Lucid, it's this. When you see a company combining unsold capacity, executive turnover, and one dominant backer, market cap stops being a measure of the business and starts being a measure of the story people believe about it. That's true whether or not Lucid's story ends well. If this structure sounds familiar, it should. That's not just Lucid's mechanism, it's almost exactly the mechanism that built and then broke WeWork. One of these companies collapsed, the other hasn't, not yet anyway.